So in this section, we'll be talking about why are stocks more tax efficient than bonds, and why do current retirement models benefit advisors more than clients? So this is part 2 of our series on how do I increase my risk-adjusted portfolio returns and minimize taxes as I plan for retirement. If you're interested in other parts of the series, we'll link that in the description below. So let's dive right in and talk about, first of all, why are stocks a better risk-adjusted and tax-efficient investment than bonds? The first reason are that stocks are taxed at lower capital gains rates. As we talked about in part 1 of the presentation, this can be as low as 0% and as high as 37%. But they're significantly lower than ordinary income rates. Another huge benefit to investing in stocks is that stock gains can be deferred until the client is in a lower tax bracket. Again, if you do this properly and you want taxable withdrawals, you can take out your gains at a 0% tax rate in retirement, up to about $100,000. Another huge advantage is when it comes to generational wealth planning and passing on wealth to your beneficiaries as your kids, is that a huge benefit of investing in stocks is that stock gains can be deferred and passed on to beneficiaries tax-free through step-up in basis. Again, 0% if beneficiaries inherit it. So there's ways to utilize stocks from a financial planning perspective that allows clients to get higher after-tax returns and the ability to pass on wealth tax-free to the next generation that you really can't get with investing in bonds the same way. So we're just going to look at real quickly a simplistic math example about how investing in stocks can provide a better risk-adjusted return for the long term when we account for both the higher returning potential of stocks as well as the higher tax efficiency of stocks. So let's just do a quick comparison between stocks and bonds. Again, we're assuming that stocks are higher returning because over the long term, stocks have earned about 10%. We're assuming in this case the gross return is a little less than 10%. We're assuming 8% over the long term, and we're assuming bonds are at about 3.5%. And as we mentioned, we can't just look at the gross return. We have to look at how those returns are taxed. So it's important to consider what's known as your marginal tax rate. Again, we're going to make assumptions here for a couple. We're going to assume it's a California married couple making about $450,000 per year. So the marginal tax rate on this couple for stocks is about 33.1% for the long-term capital gains rate, and you can see how that's broken down here. On the bonds, again, that's taxed at ordinary income, and then that's about 45.3% for this couple, and then again, we've summarized that down below here. So as we can see the two key components that I was trying to highlight here is that stocks are higher returning and you pay less taxes on the gains. And again, you can defer taxes and pay 0% if you pass it on to your beneficiaries or close to 0%. Whereas bonds are lower returning, have a lower gross return, and they're taxed higher. So the key thing to keep in consideration here is your after-tax return, right? So what are you really making from these assumptions on an after-tax basis? You can see that stocks, you're making about 5.35%, whereas bonds, you're making about 1.91%. Again, we talked about bonds have less volatility, but that's short term. But over the long term, right, you're getting higher after-tax returns. So if you have a longer time horizon, investing in stocks properly can both provide numerous advantages to both you as a client and your beneficiaries, as we'll talk about in this upcoming section. So now let's kind of quickly talk about the benefits of tax deferral. One of the things we mentioned in the previous slide was that stock gains, you can defer the taxes. You can defer it again almost indefinitely till you die and you pass it on to your beneficiaries, or you can defer it until you sell actually the asset. So we're going to go through a quick example about how that works. So we're going to use a hypothetical individual. John Smith decides to invest $100,000 into 2 index funds that earn 8% each year for 30 years, and they're both subject to John's marginal tax rate. John's total marginal tax rate is 50%. So these are a simplistic case example just to show you the benefit of tax deferral. So index fund A requires the client to pay taxes on the gain at the end of each year. So there's no tax deferral here with index fund A. Index fund B allows the client to defer all gains until the end of the year. Again, the gross return is 8%. The marginal tax rate is 50%. So kind of let's do a comparison between Fund A, which is no deferral, and Fund B, where you can defer all the gains for 30 years. Again, in both cases, the gross return is 8%. So when you look at Fund A with no deferral, the net gain is only $4,000, and the reason being is you're losing 50% of this 8% gain due to taxes. So the after-tax fund value at the end of 30 years is $324,000, right? And the 30-year, after-tax, the compound annual return is 4%. And that makes sense, right? Because you're losing 4% each year due to the taxes, so your after-tax return is 4%. However, if you can defer all the gains, what happens is each year you're getting the full $8,000 gain. You're not paying taxes. You don't have a tax drag each year, and excuse me. And that's also compounding. So that 8,000 is being added to your principal, and it's compounding. And yes, you do pay taxes at the end of 30 years, but you have the benefit of compounding over during that 30 years. And we can see that the benefit of this is that after 30 years, you have $553,000, which is more than $200,000 more than if you had no deferral. So when we look at a 30-year after-tax return, it's 5.87%. So by utilizing a fund that allows you to defer taxes, you're making almost 2% more simply by deferring the gains. And the whole point being is that to illustrate the value of tax deferral and how stocks can allow you the benefit of deferring tax gains, and how when you construct your portfolio and you're doing financial planning, right, to utilize this properly can result in a huge differential in wealth for both you as the client and your beneficiaries who will inherit it. And bond return taxation behaves more like Fund A. So when you're investing in bonds, you're going to see, again, you're getting taxes every year, whereas stock return taxation behaves more like Fund B, where you can defer most of the taxes. Again, obviously, the higher the gross return and the higher the tax rate, the higher the value of the tax deferral, right? So again, if you're in a higher tax bracket, this is going to benefit you a lot more. And if you're investing in higher earning assets, this is going to also benefit you a lot more. So now let's go ahead and talk about the problem with retirement and target date funds. And the main crux of the issue is that they heavily allocate to bonds. And we've shown in this presentation, bonds have lower gross returns and higher after-tax returns. And higher taxes. So you're getting less on an after-tax basis. Again, I'm going to just use a simplistic example. We're going to use John Smith. He's 52 and plans to retire in 13 years at age 65 in 2035. His retirement portfolio is all invested in a low-cost Vanguard target date retirement 2035 fund. The fund expense is only 8 basis points, so it's low. The expenses are low. That's great. But when we look at the allocation, we can see it's about 70% in stocks and about 30% in bonds. And as we talked about, this is going to be, the bond portion is going to be lower earning and less tax efficient than the stock portion. And so, it's not just Vanguard that does this. It's, most target date funds, if you look at your, 401k plans, your retirement models, as you get older, the retirement plan allocates a larger portion to bonds because they don't want the volatility of stocks. However, as we'll be showing later in the presentation, there's a way of investing in stocks and withdrawing money that's actually better for the client. So again, let's kind of look at why is increasing allocation to bonds a problem as clients near retirement. The first is to understand that to see what the typical stock versus bond allocations are by age. So here on the x-axis, we have the age of the client. We were starting at 20 and going to 100. Here on the y-axis, we have the percentage of allocation of the stock in stocks. So blue is again stocks. Orange are bonds. We can see when you're 20, it's 100% stocks. 30, it's about 90. 40, about 80. So you can see the stock percentage is decreasing until you get into retirement. And, around retirement, you're about a 60% stocks, 40% bonds portfolio. So the overarching message here is that as clients get older, financial advisors and target date funds allocate a larger percent of the portfolio to bonds to protect clients from the volatility of the equity markets, right? And the idea here is that when you're in retirement, they don't want you invested in something that has huge ups and downs, as we saw with the stock market, because you're taking out money, you're withdrawing money at that time. But there are better ways to kind of create portfolio solutions than, in increasing the allocation of a portfolio to a lower yielding asset that is also more taxable, right? So again, bonds have lower expected long-term returns than stocks. Bonds are more tax inefficient than stocks, and bonds will continue to experience losses if interest rates rise more than expected. So bonds are not a pure, a guarantee, against loss, right? As in a rising interest rate environment, if anyone's in 2022 looking at their portfolio returns, you'll notice that bonds have taken, heavy losses this year. So the other key problem with allocating to bonds in retirement is what's called the effect of rebalancing. Rebalancing essentially means that at the end of each year, the portfolio manager looks at the percentage of the assets in stocks and the percentage in bonds, and they want to keep that percentage at a certain rate, right? They don't want the growth. They don't want the either side to grow too much, because then the portfolio will be unbalanced. So we're going to essentially look at a financial advisor with a client who has $1 million. They're looking at they want a 60% stock portfolio and a 40% bond portfolio in their portfolio allocation. So if the stock portfolio essentially grows too fast, what they're going to have to do is sell some of the stock portfolio and invest in lower earning bonds. And you can just imagine that, before we actually get into the math, how if I'm selling a good performing asset, to invest in a lower yielding, more taxable asset, how that's going to hurt clients over the long run. And we'll take a look at that here in this example. So again, at the start of the year, the client has $1 million. These are their tax rates. Again, we can see that the tax rates for bonds are significantly higher than the tax rate for equity markets. The start of the year, they want that 60% portfolio, 60% in stocks and 40% in bonds. So it's going to be $600K to stocks and $400K to bonds. Here's the $600K in stocks and $400K to bonds. We're assuming that the stock grows at 8%. Again, we're assuming that that's tax deferred, right? You can defer most of these gains. The bond growth we're assuming is at 3.5%, but that's taxable every year. So as we're going to see in the example below, the stocks are going to grow at a faster rate. But because the stocks are growing at a faster rate, and the portfolio manager wants to maintain the 60% stock portfolio to 40% bond portfolio ratio, they're going to have to sell stocks to invest in bonds, and the taxable outcome is going to hurt clients here, as we'll see in a second. So again, the starting value for stocks is $600K. The starting value for bonds is $400K. So if this is making 8%, so 8% on the $600,000 is $48,000, right? If the bonds are making 3.5%, that's $14,000 on this $400K. So we can immediately see the gross return is a lot higher, right, on the stocks than the bonds, is what we expected. The next thing is we have to consider taxes, right? Well, what's going to happen with taxes is, like we said, when you invest in stocks, most of this is going to be tax deferred. So we're looking at that you're not really paying taxes on this 8%. So there's zero taxes due here. Whereas in this case, on the bond side of the portfolio, it's $14K in gross gains, but then it's subject to this tax rate. It's subject to this 45.1% tax rate. So you're losing that amount. So now you have, when you add the 14, you have to subtract the taxes you pay on it. So the net gain is about $7,000, or almost 7.7. So you add that 7.7. And so this bond portfolio has 407.7, whereas the stock portfolio has the full 648, right? There's no taxes here owed. The issue, though, is that let's do our percentages again. Now I have 648,000 invested in stocks and 407,000 or 408,000 almost in bonds. Now my portfolio, the percentages are off, right? It's not 60-40 anymore. It's 61.4 in stocks and 38.6% in bonds. So now it's overweighted to stocks. So now what does the portfolio manager do? Well, they have to say, wait a minute, like I want to reduce my allocation to stocks and increase my allocation to bonds, which means then I have to sell some of the assets in the stock portfolio. So what they're going to do is they're essentially going to sell $18.2 million, or sorry, not $1 million, $18,000 worth of stocks. And they're going to sell $18,000 worth of stocks, and they're going to buy $18 million worth of bonds. However, by doing this, you're paying taxes, right? You're essentially, when you sell an asset, you're paying taxes on the gain. So before, when you were just deferring it, you weren't paying any taxes. But now that you've actually sold it, there's rebalancing taxes due here, right? So you're paying taxes on the gains. And yes, it's the lower 33%, but you're still paying taxes, and that's a drag. So you're not getting the benefit of deferral. So again, you're selling 18, but then you're paying 6 in taxes, so you're adding about 12 to the bond portfolio. So now it's going from 407 to 419, and then again, this is going down by the full 18. You sold the 18 here, so now it's from 648 to 629. But now I'm in alignment. Right now, the financial advisor is like, I'm back to my 60% portfolio and 40% bonds, right? I'm maintaining my 60%, 40% ratio. So this is essentially rebalancing, and you can immediately see the problem, right? Like, I'm selling a higher earning asset to invest in a lower yielding asset, and I'm paying more taxes for doing it. So the key thing that I want people to take away from this slide is that rebalancing away from higher earning tax efficient stocks to lower earning tax inefficient bonds actually reduces wealth over the long term because of both the drag of taxes and the lower yielding return of bonds. Next, I want to talk about the value of financial advisors, right? So financial advisors can provide either immense value or immense expense, and it's really dependent on what that financial advisor is providing you relative to the fee. So in this slide, we're going to look at a couple of things, a financial advisor versus managing your own investments, and compare the fees, and then we'll talk about value. So the three different fee structures we're going to be talking about is the management fee, the custodian or platform fee, and then the underlying fund manager fee or expense ratio of the fund. So we can see a financial advisory firm typically charges you a management fee or advisory fee of about 1%. So if you're giving them $1 million, they're charging you 1% or about $10,000 a year just to provide advice for that. The next thing is the custodian fee. So typically, financial advisors will have the assets custodied or, at a certain bank or institution, and that institution charges a fee, roughly around 10 basis points. The next fee is the underlying fund fee or expense ratio of the fund. So the advisor is just charging you a fee to advise the assets, but he's not actually managing the underlying funds. He's allocating you to a fund. And those funds have fees. Those fees are typically about 0.3% to 0.5%. So when you look at the all-in fees, it's about 1.4% to 1.6% of using a financial advisor. So now let's kind of look at the fees of, whether if you do it yourself or self-advised, right? So there's no management fee because you're doing it yourself. You're opening up your own brokerage account at Vanguard or Schwab or Fidelity, and there's no, custody platform or kind of commissions associated with that. The underlying expense ratio of the funds, the fund manager, are really low. So that's one of the benefits of using, these options, Vanguard, Schwab, or Fidelity, right? So the expense ratios are really low. So when you just compare expenses, we can immediately see that the total all-in cost for the financial advisor is a lot more, multiples more than, doing it yourself. However, that doesn't mean that everyone should go to a financial or everyone should manage their own investments, simply because that presumption assumes that the financial advisor has no value, is not providing value in relation to this fee. So it's really important to understand what is the value the financial advisor is providing and if they are, because not all financial advisors are providing the fee. If they are just simply taking your money and dumping you into the same funds that you could invest in by yourself at Vanguard or Schwab or Fidelity, then they, by all means, are not deserving of the fee, right? If they're not coming up with creative solutions to help you minimize taxes and maximize wealth, and working with you kind of to devise strategies, again, not really worth the fee. So the key thing I'd like you to take away from here is that, adequate financial planning and advising can add immense value, but it can also be a huge expense. So it really depends on what that individual firm is providing for you and your ability to evaluate their value proposition. And I especially mention this because not all financial advisors provide equal value relative to their fees, right? So a lot of financial advisors are simply salesmen. They're selling services as opposed to really strong financial planners or investment advisors. And it's important to try to understand which is which, right? But it's very hard to do if you don't have much financial background or literacy or education. And that's why it's important, just to get a level of understanding so you can evaluate who is providing what value. And you're not just choosing a financial advisor based on comfort or trust or what their website looks like or simplistic things that the financial advisor makes you feel about their service, right? There has to be a way for you to evaluate the actual value proposition that they're providing. And the other thing to think about is, everyone thinks that they can do it themselves, right? I'm just going to go to Vanguard, and again, because the expenses are a lot less, but that again presumes that you have the knowledge that is equivalent of the financial advisory firm. And while not financial advisors provide the same quality of advice, that doesn't mean you can kind of provide that level of a high quality financial advisors. So the question to really ask yourself is, do you want to spend hundreds to thousands of hours learning all the ins and outs of the financial advisory industry, or do you want to pay a fee for a qualified firm to kind of handle some of this stuff for you, to help you devise strategies, to help you understand, risk tolerance? So the next thing I kind of want to talk about here is we talked about how, the allocation to bonds as clients get near to retirement doesn't make a lot of sense for clients. So I'm going to do a deeper dive here in showing you why on an after-tax, after advisory fee basis, it really doesn't make sense for clients, especially, as most financial advisors and retirement funds are going to that 60-40 type portfolio. So we're going to look at, the gross returns of stocks and bonds, and then we're going to look at taxes. We're going to look at all the fees, and then we're going to see what's the net return for the client, for stocks and bonds, right? So stocks, again, we're making an assumption of 8%. I know the long-term return is around 10%, but this is a little bit conservative. Bonds right now are about 3.5%. And here's taxes on this. So we can see the after-tax returns right before fees is 5.35, 1.91. Again, the wealth manager is charging 1% on these assets, and we can immediately see there's an issue here because stocks are doing well, on an after-tax basis. But so the fee is not that large relative to this, but on the bond side, on an after-tax basis, the fee is more than half of the after-tax return, right? And then there's a fund manager fee and underlying, again, the expense ratio of the funds. So the stock fund fee is going to have a fund. Again, it's not a Vanguard fund if you're using a financial advisor, right? So 0.5% and 0.25%. These are the assumptions here. Again, the platform or custodian fee. And then we have inflation, right? Again, right now inflation is really high, but long-term inflation is around 2%. So when we subtract all these expenses and costs, we can see that the net return to the client on the stock side of the portfolio is only about 1.5%, but on the bond side, it's actually negative. So this is another reason why a heavy allocation to bonds as you near retirement, especially if you're using a financial advisor to do this, doesn't make a lot of sense. So the after taxes, fees, and inflation bond returns result in negative returns for clients. So if you're really looking, financial advice can provide a lot of value, but they need to implement strategies that account for this, that provide better stability than bonds, that provide better after-tax returns and better ways to pass on wealth. So just quickly, I want to talk about, if in these last few slides, we've seen that, using bonds in retirements don't really make a lot of sense for clients. So why do retirement models, why do financial advisors use this strategy of increasing the allocation to bonds if they're lower earning and tax inefficient? And the real core of the reason is that this kind of practice, this model makes a lot of sense for financial advisors because it's simple. You can, it's easy enough for them to allocate a certain percentage to stocks and bonds and call it a day. They can easily rebalance it. They can easily say, okay, we're moving it as you get closer to retirement, we're moving it into a safer asset allocation, and it makes their job easier, and it's easier for them to scale. And And there are values to bonds, right? The bonds are less volatile than stocks, right? So it helps reduce the volatility of your portfolio by including that, especially as you're entering retirement and clients are making withdrawals, right? Because there's something called sequence of return risk that if you're taking losses while you're making withdrawals, your portfolio can really deplete. And so using bonds can help, prevent this or limit the sequence of return risk. So that's kind of why financial advisors kind of increase the allocation of bonds. Is one, it makes their job easy, and two, it helps reduce the sequence of return risk and reduces the volatility. Another key reason is that clients worry more when they see losses than when they see gains. So especially if you're in retirement, you're really sensitive to losses in your portfolio than if you're in your 20s or 30s and you have a long horizon. However, that doesn't mean that bonds are really make the best sense or they're the best solution to accomplish the same goals. So one of the things you really should be thinking about as in retirement is how can I implement better risk-adjusted and tax-efficient retirement solutions, right? So instead of bonds, what can I do to reduce volatility, to minimize taxes, to increase after-tax returns, right? So a couple solutions we'll be talking about in the next sections of this presentation are retirement solutions. In place of bonds, what can we do to protect against volatility and minimize taxes? So we'll be talking about two things. One is protected investing and portfolio borrowing against your portfolio. So protected investing simply allows the clients the ability to protect against losses and get tax-deferred or tax-free growth in place of giving up part of the upside. So what that really means is that protected investing can protect you against losses. So you don't have to worry so much about losing money. However, in exchange for protecting you against losses, you're also giving up a part of the upside, right? So you're not getting 100% of the upside when the stock market or when your investment does well. And that's kind of the trade-off, right? You're getting protected against the downside, but you're giving up part of the upside. So what that does, though, is it limits the volatility. Remember we talked about how bonds can limit volatility. Well, protected investing will actually show you does that better, especially when we look at it on an after-tax basis, because protected investing has a lot of tax benefits that simple allocation of bonds does not. The next thing we'll be talking about is essentially borrowing against your portfolio instead of taking taxable withdrawals. One of the things we saw about, especially when we were doing the rebalancing, was that when you rebalance, you're paying taxes just to allocate money from stocks to bonds, right? You're taking away from a higher earning assets, you're paying taxes, and you're losing the ability of tax deferral. So the next thing we'll be talking about is why borrowing at low levels and at low interest rates against your portfolio allows investors the ability to invest in higher yielding equity assets without really paying large amounts of taxes, which then allows clients the ability to pass on more wealth tax-free to beneficiaries. So I'm just going to use a quick example. Again, we'll dive into this more later on in the presentation. Which of the two options would you rather do? Invest in a portfolio making 6%, in which you pay 30% to 40% taxes each year on the gains? Or would you invest in a portfolio making 8% that maximizes the benefit of compounding due to minimal taxes owed? And if you do need liquidity and to pull money out, you can borrow at low interest rates, which are significantly less than the 8% that it's compounding at. So we'll go on into deeper detail later on in the presentation, but these are two important things to consider, both protected investing and borrowing against your portfolio or utilizing margin.